Welcome to Money Moves for CRNAs, the podcast created specifically for 1099 CRNAs who want clarity, confidence, and control over their money. This podcast is for educational purposes only and is not personalized tax or financial advice. Here's your host, Randy Larkin, with Atlanta Tax Planner.
Okay, let's talk about Trump accounts, because I got a listener question about these. And this is exactly the kind of topic where people hear one headline, they think they understand it, and miss the part that actually matters. Because once people hear Trump account, they usually assume three things. Every kid gets $1,000, every child qualifies, and parents can invest the money however they want. That is not how this works. So today, let's break it down in plain English. Who can have one? Who actually gets the $1,000? Whether your child has to work? How much can go in each year? And what the investment rules really are. First, the big picture. Trump accounts were created by the One Big Beautiful Bill Act, which was signed into law on July 4th, 2025. They're a new child-focused IRA-style account under Section 530A. A child can generally have one if the child has not turned 18 before the end of the calendar year in which the account election is made, and has a valid Social Security number. So this is under 18, not 18 and under. Now here's the first big misconception. Not every child gets the $1,000. That one-time federal seed contribution only applies to a narrower group of kids. The child generally has to be a U.S. citizen, have a valid Social Security number, and be born between January 1st, 2025 and December 31st, 2028. So if your child was born outside that window, that does not automatically mean they cannot have a Trump account. It just means they generally would not qualify for the government's $1,000 deposit. Next question. Does the child have to work? No. That's one of the biggest misconceptions here also. During the child's growth period, contributions can be made even if the child does not have earned income. Parents can fund it. Other people can fund it. It does not have to come from the child's wages. And it does not have to come from the child's employer. So, how much can go in? The general annual limit during the growth period is $5,000 per year, with inflation adjustments after 2027. Regular contributions can begin starting July 4th, 2026. That $5,000 is the main annual bucket families need to think about. There is also an employer angle. Under Section 128, an employer can contribute to the employee's Trump account or to the Trump account of an employee's dependent child. But there's a separate employee limit of $2,500 during the growth period, and that still counts toward the overall $5,000 annual limit. So this is not $5,000 from the parents plus another $2,500 from the employer. It all fits inside the same cap. Now, let's talk about the investment rules, because this is where the account is a lot more restrictive than people think. This is not a free-for-all brokerage account. During the growth period, the money generally has to be invested in a qualifying mutual fund or ETF that tracks the broad index of primarily U.S. companies. Think broad U.S. stock market exposure, like a S&P 500 type fund. Not just any ETF qualifies. The fund cannot use leverage, and the annual fees and expenses have to be 0.1% or less. So no individual stocks, no leveraged funds, and no high-fee products. And one last planning point. The special under 18 rules are tied to the calendar year, not the child's exact birthday. Once the calendar year begins in which the child turns 18, The special growth period rules generally stop. So there's no prorating based on whether the child turns 18 in February or October. After that, traditional IRA rules generally begin to apply. So here's bottom line. A Trump account may be available for a child under 18 with a valid Social Security number. Only children born from 2025 through 2028 generally qualify for the federal $1,000 seed contribution. Parents can fund the account even if the child does not work. The annual cap is generally $5,000, with inflation adjustments after 2027. Employer Section 125 contributions can help fill that bucket, but they count toward the same annual limit. And the money has to stay in qualifying, low-cost, broad U.S. stock market index mutual funds, or ETFs, with fees of 0.1% or less. So yes, there may be an opportunity here for some families, but the headline is not the strategy. The real question is whether it actually fits your family's bigger planning picture.
Thanks for listening to Money Moves for CRNAs. New episodes drop twice a month. See you soon. Music licensed from premiumbeat.com. Under license number 7394047.